Here's what's coming up on The Retirement Architect with David Reyes, your retirement television.
We want the most amount of income, least amount of risk, never run out of money. Most amount of income, least amount of risk, never run out of money. So that's the job of what I do every day, right? So the fact is that we go through that process and we'll determine what is the maximum income that we can have. Most of our clients can create way more income than they thought they could. And remember, during retirement, you're taking distributions of that asset. You lose half your portfolio and you're taking out 4 or 5%, you're probably gonna have a problem. No question you're gonna have a problem. Either gonna have to go back to work or you're gonna have to reduce your quality of life. We don't wanna do either of those things.
Man, it's difficult to know what you're paying in fees, right?
It is, it is. Again, it's part of our second opinion process. We do a fee analysis, risk analysis, retirement income plan, so it's just built in. We wanna shine the light on the fees. People don't realize this because they don't manage their money that way, or most advisors don't manage their money that way, is they're investing in individual stocks or bonds, but there's no purpose to that relative to the retirement income planning. So we just do it completely different, right? I always tell clients, I promise you one thing, you're gonna see things you never saw before. I'm gonna look at your portfolio. First I teach them what they have, and then I teach them how I see what they have.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Hi, San Diego, and welcome to this week's show.
Stay tuned, we have 30 minutes of great information just for you.
Don't go anywhere, the show starts right now. Hi, and welcome to this week's Ask the Architect, where you email your questions in from all over San Diego and we answer them right here on the show. David, I have some great questions this week, and I'm going to begin with Robert from Oceanside. Hi, David. I've been reading a lot lately about how much risk mutual funds have and how high fees could actually be. I just retired after 35 years as an engineer. I no longer want to take as much risk as I used to. I want to know what my fees are. What do you suggest?
Well, Robert, thanks for the question. You know, there's a lot of things going on there. You're talking about risk and fees, and love that you're an engineer. We have a lot of engineer clients, and I like that because an engineer is like, if you have a plan, and we do planning first, investing second, is that if you have a plan, they like the plan, they'll hire you pretty much. You know, it's great. So, you know, lots of things going on there. But yeah, the mutual funds, you know, the reality is in 401k plans, that's all you can invest in. So most people, that's all they have is mutual funds. So mutual funds can be risky. If it's a stock mutual fund, you're going to have stock market risk. If it's a bond mutual fund, you're going to have bond market risk. So, and unfortunately, the fees inside of mutual funds can be as high as 2-3% depending upon, you know, what you own. So there's lots of things happening in that question he has with fees and risk, but that's part of what we do in our process.
Yeah, and I love the part about the plan, David, because I always like to ask this, and we've talked about this on other shows. How many people come into your office, show you all their accounts, and the written plan that's been put together, right? Because they have all the accounts, but nobody's taken the time. And I'm addressing this in particular because San Diego's filled with wonderful engineers. They're going to retire at some point. They're into meticulous planning. Talk about your planning process.
Yeah, so it's pretty straightforward. I can tell you off the bat that I can count on one hand the amount of clients that have come to my office with a written plan. Maybe less, maybe 2 fingers. I don't know. I'm trying to be generous here, but the fact is that most firms don't do any plan. So we're going to do 3 things. We're going to do a stress test of the portfolio. What kind of risk do you have in the portfolio? What kind of fees are you paying? And then we're going to do a written retirement income plan. Right? So it's a very methodical process. It can take 2, 3, 4 meetings to go through this process, but that's what it takes to educate and teach the client not only what they have, but also how we see what they have. You know, we have a saying in our firm, you retire once, we retire every day, because we do. And so we're going to have a different perspective on your investments because they're there to do a job. They're there to give you income in retirement, not just to grow. So we love doing that process, and it's fun, and it's fun for the client as well.
Thank you, David. My next question is from Carol in Point Loma, and she writes, The thought of having an actual written plan sounds awesome. Piggybacking on our last question, we've had advisors over the years that have never put together a written plan for us. We have almost $2.5 million saved. Is this enough to create a retirement plan? Can you please describe exactly again what a written plan is and how it works?
Wow, two of those. Thanks for the question. Yeah, it all starts, an old saying I have is begin with the end in mind, right? The end is the beginning of your retirement is cash flow, right? We want the most amount of income, least amount of risk, never run out of money. Most amount of income, least amount of risk, never run out of money. So that's the job of what I do every day, right? So the fact is that we go through that process and we'll determine what is the maximum income that we can have. Most of our clients can create way more income than they thought they could. So that's the fun part. And clients get to retire earlier, or they get to retire with more income. So we basically are going to go through our three-step process, which is the fee analysis. What are you paying? Your risk assessment. What kind of risk do you have in the portfolio? And then the written retirement income plan.
My last question is from Henry in Encinitas, and he writes, David, I'm 62 and plan to retire when I'm 65. I have $1.2 million tied up in my 401k, $100,000 in the bank, and $700,000 in a brokerage account. Would you recommend seeing an advisor now or waiting until after I retire?
Well, Henry, again, thanks for the question. And always see an advisor now, because number one, you can get educated on what's possible, right? Whether you hire that advisor or not. But the sooner you do the plan, and again, I call it the retirement red zone, was 5 to 10 years. In 2 years, you're right there. But it's never too late. Quite honestly, most of the clients that come see me are already retired. So you're already ahead of the game. So the reality is helping you to, do I want to choose Social Security benefits now? Is there certain investments that will maybe produce more income that I invest in today versus later? So good question, and lots of things that can be done.
Yeah, and I want to address one other thing. We talked about this in a previous show. The income piece, hey, income is the outcome. Got to know how much I can spend every month of every year for the rest of my natural life. But we can't overlook the other components. Yet you need to see an advisor about it, in particular a specialist, not someone that just helps you accumulate, but then helps you make the transition into distribution. Taxes, fees, legacy, and all the other pieces, right? Which a lot of people don't necessarily think about. They just think about the overall money. Fair statement?
Absolutely. The key I would give you, the advice I'd give you as well, is see somebody who is a retirement income planning expert, because that's a totally different story like you're talking about, Mark. The accumulation is really the easy part. Spending your money is a lot harder. Psychologically, actually doing that. So I'm glad that at least he's, thinking about that.
David, thanks so much. If you want more information about anything we spoke about here today, give us a call in the office or go to our website, and don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Are you unleashing the possibilities of your assets in retirement? Hi, I'm David Reyes with Reyes Financial Architecture. As a retirement and investment advisory firm here in San Diego, we've helped countless retirees and pre-retirees create a cohesive plan to maximize their assets and, most importantly, their cash flow in retirement. Call 866-REYES-PLAN right now to schedule a complimentary second opinion review. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
All right, welcome back to 600 AM, The Retirement Architect. We're here with David Reyes. He is a best-selling author, TV personality, and of course the host of this show. David, we have a very important topic today, and that's how much can I afford to withdraw in retirement? This is huge.
Yep.
We talk about in several programs, savers need to become spenders. They need to figure out how to make that transition. But it's not just about making that transition, right? I want to know that number. What is that number? I want to maintain my lifestyle. I don't want to have to go back to work. I certainly don't want to move in with the kids, right? So the first one in there is begin with the end in mind, creating that budget, right?
Yeah, great book I read a long time ago, Stephen Covey, 7 Habits of Highly Effective People. That's one of my favorite books. Read it, I think I was 23 years old. And that's one of begin with the end in mind. He talks about your eulogy, right? Write your own eulogy. What do you want to be known for? And it stuck with me with planning. That's what I do. Begin with the end in mind. The end is the new beginning. The end of your job, the beginning of your retirement. So that ultimate end, we have to replace the paycheck. So cash flow is the most important. So again, everything starts with how much income can we produce from the portfolio.
Here's something that comes up from time to time. I think that individuals and couples going into retirement think, oh, I'm going to spend less. But the reality is that you're used to a particular lifestyle, and now there's no longer 40 hours a week. that you have to tend to a job, now's the time to go to Italy and take the cruise and visit the grandkids.
That's right.
So the reality is that your expenditures could potentially go up
Exactly.
in those early years. So you need to know what you can afford to withdraw. Is that a fair statement?
That's 100%. I mean, really what clients pay me to do is give them peace of mind. In the end, it's for them, okay, you're okay. It's that confidence, it's that reaffirmation that we all need in different parts of our life, whether it's a doctor, whether it's a relationship. I always say I'm half camp counselor, half advisor, right? Everybody I say has a story, right? Once I understand their personal story and their money, then it's easy. Because you're building the plan, it's about people. The math is easy. Doing this for a long time, that's the easy part. The most fun part is getting to know the client and saying, how do we do it? How do we do this to have them do all the things they want to do? Grandkids are probably the number one issue as far as expenditures. Grandkids,
sure,
travel, gifts, fun. I want to have all the grandkids over for Christmas, for Thanksgiving. So you hit the nail on the head. So we just want to have what's the maximum lifestyle we can create for a client, and typically it's more than they think. But most important is the confidence that they walk away with.
Yeah, and I was talking to a colleague of yours recently, and he was telling me how he was sitting with their long-standing clients, and they wanted to do something special.
Okay.
And the special was take the entire family to Hawaii.
Yeah.
And they helped them with the trip and the planning and the dollars and all of that. And they sent pictures back, and he really just, I could see him glowing for his client about this. And I think there were close to 30 people in the family that went and all. I don't know the dollar figure around that, but yeah, you got to make sure, right? If you're going to do these things, and this leads me into the next one, it's cash flow. It's all about cash flow, David, right?
Yeah, it's again that begin with the end in mind. The beginning of that is again the income, and so then again you're building the portfolio, which is different. People don't realize this because they don't manage their money that way, or most advisors don't manage their money that way. Is they're investing in individual stocks or bonds, but there's no purpose to that relative to the retirement income planning. So we just do it completely different, right? I always tell clients, I promise you one thing, you're going to see things you never saw before. I'm going to look at your portfolio. First, I teach them what they have, and then I teach them how I see what they have. It's a totally different litmus test to what they, because we need the money now to do a job for them, to replace that job, to replace that income. So the cash flow is fundamental, and unfortunately it's just a missing piece in our industry. There's very few advisors that have expertise on retirement income planning.
Yeah, and I think that's really important underlying exclamation point here, that most advisors, and I'm going to make a wide sweeping generalization here, David, are quite good at accumulation.
Yeah.
Okay, it's a fundamental part of retirement.
Absolutely.
You have to build a nest egg.
That's right.
However, when you get into that retirement red zone, that 5 years out, maybe it's 10 years out, maybe you're in retirement, man, the whole fundamental strategy of retirement must change to preservation and distribution, and not all advisors are created equal here, David. Right, you need to see what is referred to in the industry as a retirement specialist, who can navigate the waters of, this is different now. We're not just saving, we're spending. We have all the different things involved here that are going to be part of your retirement: fees, taxes, legacy, healthcare, all of those pieces. And maybe you're a DIY investor, David, and you did a heck of a job with it, but you are not a retirement specialist. Okay, you did a heck of a job putting it all together. And by the way, there's a lot of smart people out there. You see them every day, David. They come in, a lot of engineers in San Diego, right?
Yeah,
they're coming in with their color-coded spreadsheets, and they've done a heck of a job. But now it's different. And you have to make sure that nest egg you planned for, worked so hard, sat at the table to sacrifice for, gets distributed properly. Or what happens? You run out of money at the end, and we certainly don't want that to be the case here. And the last piece of the puzzle is risk. How do we mitigate risk in the whole world of withdrawing for retirement?
Yeah, so the problem is, I always call the dirty little secret on Wall Street is that buy and hold has been sold to people because that's how the investment community makes their money. So if they ever sell stocks, they can't bill you on those stocks anymore. So that doesn't mean you do that, but you should have a part of your portfolio that has risk mitigation to it. Right, so if we're looking, if you were here in front of me live and I had my whiteboard, we're going to do a big pie chart. We're going to say, okay, here we're going to have dividend-paying stocks. We're going to have real estate potentially. We're going to have a risk-managed portfolio that's going to manage risk. We may use other types of guaranteed lifetime income products or principal-protected product strategies. And so the fact is that those are the ways that you can diversify risk above and beyond stocks and bonds and have active risk management as part of your portfolio.
David, thank you so much. Hey, if you want a complimentary second opinion, it's real easy. Just pick up the phone right now, 866-REYES-PLAN, or visit us on the website, reyesplan.com. And San Diego, don't you dare go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
Hi, and welcome to this week's Retirement True or False. David, I got some goodies this week. My first one for you is most retirees and pre-retirees know the fees associated with their portfolio and investments. True or false? And I can't help it.
I don't know.
Because we all know, we've talked about this so much, and it's a big, I'm going to say it for you. Ready? False.
There you go. Yes,
it's a big false,
You got
and
one
we
right.
talk about it regularly. You talk about it on your radio program. We talk about it here on the TV show. Man, it's difficult to know what you're paying in fees, right?
It is. I mean, it is. Again, it's part of our second opinion process. We do a fee analysis, risk analysis, retirement income plan. So it's just built in. We want to shine the light on the fees. And unfortunately, clients tell me all the time, well, I always ask my advisor at XYZ company what my fees are in total. And it's always like, that never gets answered. Clients tell me that all the time.
So, and then there's the one, and we've talked about this, well, I'm only paying 1%.
Yep.
Or I'm only paying 1.5%. And you know what? It's a half truth. It's a true and false, because maybe to your advisor, you're paying them 1%.
Exactly.
However, the products in your strategy have fees associated with them. So it's sort of a half truth. Fair statement?
Yeah, here's the worst part. I mean, there's a particular institution I won't name. It's a big bank you would know, and they're the most egregious. So they're making money in two ways. Their advisor charging a fee, plus they're also getting kickbacks from the mutual fund company. Okay, it's very common. You can look it up. I have their disclosures in my office.
The fact that you have to say the word kickback.
Yeah, that's
right?
just the way it is.
And you know, that is,
We don't receive any compensation from mutual fund companies. We don't even barely use mutual funds. So we're using the least expensive ETFs and stocks. So the fact is that when we do the fee assessment, we're going to look at that. So the problem is there's heavy conflicts of interest there that need to be addressed.
So clearly, and I'm going to bring up the 50-cent word of the year, which is fiduciary. That particular company, is it safe to say, would not fall under the fiduciary standard?
That would be false.
That would be a big
that would
false.
be false. Yes.
All right, question number 2. Most investors are aware of the amount of risk they have in their portfolios. I'm doing it today. False!
Yeah, you're cheating, man.
I am cheating.
No,
I'll give it to you.
No, it's all right. Got it. No, that's false. False
It's another
for sure.
big one, right?
Yep.
This is another big one that we
Yep.
talk about on a regular basis.
Yeah.
I don't know why I feel the need to take away that false from you, my friend.
Yeah, that's all right.
Stealing
We're
your
good.
thunder.
We're good.
My bad.
No, so the reality is that the risk that people take on, again, especially when they're accumulating assets, it's not as big of a deal. We're contributing lots of money. The average client that hires me is probably putting $50,000 a year away in their retirement. I tell them, that maybe you're a little more, aggressive in their minds. Well, yeah, 10 years ago when you had $1 million, right, and you're putting $50,000 a year in, right, that's a big difference than now you got $2 million, you're putting the same $50,000 in. What's more important?
Right.
Protecting the capital, or you're going to be able to outpace the losses by making more contributions. So once you kind of explain it to them that way, they get, I got to protect what I have over here, right? Be more aggressive with the contributions then. Sometimes we do that. We do that a lot, actually. When we do rollovers from 401k plans to IRAs, we're going to now protect the capital that they moved the $1 million, and the $50,000 a year they're putting in for the next 3 or 4 years, fine, go crazy. We can be aggressive because we're starting from zero in that account.
Right.
Right, so we do that all the time. We're not going to buy bonds when we have zero money in the 401k plan. We're going to be aggressive with that money, and we're going to protect the corpus, the capital that they've spent so long, accumulating.
So let's walk this down the path a little bit, because the risk piece then really becomes a lot more important when you're in that red zone that you talk about, because there aren't a lot of years of work left to make up for big losses. So protecting what you have and mitigating risk, important?
Absolutely. I mean, it's the most important, because think of it this way: if we're relying on that $1 million, $2 million, $3 million for income, and now it's half that, well, you have half the income.
Yeah.
So I mean, there's no real benefit to do that unless it's just greed, and those are not going to be my kind of clients.
And David, you worked so hard to get to that place, to be 5 years, 4 years, 3 years, I'll say 6, 7, 8 years.
Yep.
You know, but certainly when you're in that 5-year period, man, you don't have the time to make that up. Protect what you have, mitigate risk. All right, last question. You don't need to use a different strategy. I won't answer, I promise this time, okay? You have the cards, I'm gonna let you do it. You don't need to use a different strategy when you move from the accumulation stage of your retirement to the distribution stage of your retirement. True or false?
That would be false. Absolutely. Yeah. There's unfortunately, most clients don't even think about that. They just think, because they've been trained, you buy and hold, and mark goes up, mark goes down. That all changes when you start taking income, like we talk about all the time. So what you want to incorporate is think about, okay, I've got my $1 million, $2 million. I want to protect that capital. I want cash flow from those investments. I want to grow the money. Absolutely. Our clients we're going to grow our money, but it becomes last in line. I got to have the money to produce the cash flow. And that's what we're trying to do, is replace paychecks. So it's just a different mentality. So we're going to use different strategies. We may incorporate real estate investments, maybe some retirement income, lifetime income products that will allow us to get guaranteed lifetime income. And so there's just different things to use. And again, I'm agnostic to it. It's a toolbox. I want to use, what do I need to satisfy my job is to protect capital, create cash flow, grow capital, in that order.
And I always like to talk about this too, because I think a lot of people don't put this high on the radar of retirement. There are other pieces besides the income and growing your assets. There's the healthcare piece. There's the legacy piece. There's the reduction of taxes piece. There's the reduction of fees piece, right? There's the Social Security. How does that fit in? Maybe some legal things like the trust and all that. So now is the time, David, to move from your general practitioner to your specialist, which is the retirement planning piece.
Exactly, retirement income planning piece, right? Because all those things, what, do taxes affect your income? Yes, right? And it's a big cost. It can be 20, 30, I have clients that are in a 50% tax bracket, right? It can be half your income, right? Successful business owners, most are in the 50% tax bracket, right? And we have a lot of business owner clients. But the average person in retirement is going to, a married couple making $100,000 a year, it's about 15 to 20%. It's not astronomical, but if we can do things to mitigate cost, then we're going to focus on that. Absolutely.
Right. And in particular, if you're a business owner, right?
Absolutely.
There are special things in the tax code for you that you need to, maybe you've already investigated, but it's good to, again, have a second set of eyes.
Absolutely.
And David, thank you so much. Speaking of a second set of eyes, if you would like to get a complimentary second opinion, give us a call right now in the office, 866-REYES-PLAN, or visit our website at reyesplan.com. And don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Now more than ever, it's vitally important to review your current retirement plan and get an educated second opinion. Hi, I'm David Reyes, and for many retirees and pre-retirees, this is a very confusing time. As a family-owned business right here in San Diego, we have educated hundreds of families on how to retire with confidence in all market conditions. So let us help you. Give us a call at 866-REYES-PLAN for a complimentary second opinion. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Today I want to talk about losses in retirement, or avoiding losses in retirement. Most clients, when I do, one of the first things we do is do a risk assessment. And we're going to look at, you've got X amount of stocks and bonds, whatever you have, and during a stress market like 2008 or 2000, how much did you lose, or how much would you have lost? And most of you are going to lie in this 30 to 50% range, believe it or not. Even if you had a portfolio of 60% stock and 40% bonds, during 2008, you were down about 35%. If you were 100% stock, you were down about 55%. Okay, and most of you don't realize that. Part of that because when you were working, you were still saving money, right? So you were still contributing, so it kind of hid the losses, which is nice. Problem is back then, maybe you had 100,000 or 200,000, you're adding 50,000 a year. Now you might have $1 million, $2 million, right? Even if you're saving $50,000 a year, that's a small amount. So it doesn't make up for the losses in a really bad market. So we want to stay in this 10% range as a maximum. That's where we try to stay with our clients, right? Because the fact is, if I lose half my money of $1 million, that's $500,000. That's painful. And remember, during retirement, you're taking distributions of that asset. You lose half your portfolio and you're taking out 4 or 5%, you're probably going to have a problem. No question you're going to have a problem. Either going to have to go back to work or you're going to have to reduce your quality of life. We don't want to do either of those things. We want to be, even if we were in this 20% range, right? If you have a 20% loss, you need about a 25% return to get back to even. A 10% loss, I'll need about 11% to get back to even. We want to stay maximally in that range because the fact is that's reasonable. But we want to stay kind of in that 5 to 10% if we can, if possible, because nobody wants to see their brokerage statement do this, especially when we're in retirement, we're taking income, right? On top of that, what if we go through a financial crisis again? What if we're in the middle one right now? We don't even know it, right? We only know with the benefit of hindsight. The fact is, what about medical costs? One of the big concerns that a lot of my clients have, and especially today, most clients don't have long-term care policies. So that's a big tail risk we have within our investments and within our retirement, because the fact is, A, if one of us needs, or both, some type of long-term care, dementia, Alzheimer's, this is a problem if we lost half our money and then we have an illness, right? Because not only is it going to affect our retirement income, but it's also going to affect our ability to transfer assets to our beneficiaries during, post our death. If you have any questions about any of the things I've talked about here and you want to get your own risk assessment or second opinion, please give us a call or go to our website.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have, by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
Thanks so much for watching this week's show.
And if you want more information about anything we spoke about here today, give us a call in the office or go to our website.
And remember, you retire once, we retire every day.